Okay, here we are back at our live trade example, and as before, we were short the euro dollar US dollar, and let's take a look at where we are today. And this is the very next day. We're up 123 pips. So in this case, we're using a lot size of 0.1 rather than 1 in a standard account. In a standard account, this would be, or standard lot would be $1,237 basically. So 123 pips would be $1,230. That's how far we'd be ahead in this particular trade. Okay, so let's go down here. Take a look at modifying our order here. Now we can get out here, or we can stay in here. We have a couple of different choices. And again, this is an example trade. So I'd like for you to see an example of getting out of a trade at a profit. What we're going to do is I'm going to expand here so you can see the move that has been made from our short entry. Market did go up, move against us, came to our favor, came back up, and then proceeded downward from there. Okay, so here we go. Without further ado, let's get out of this trade. Modify, delete order. Okay, we're going to close this out. So put instant execution. I'm going to close the sell out, and more. The market's still moving down. So here we go. All right, that's it. Now, as you'll see, that trade's completely closed out. Let's go back over here. And this is something that you always check. There's no profit target line. There's no stop loss line. So there are no pending orders. That is a good thing. That's exactly what we want. The order here canceled out the stop loss, canceled out the take profit, and closed at 1.47134. This means our profit on this particular trade was $125 because we're using a 1/10 lot size, standard lot size, in a standard account that would have been 125 times $10 per pip, which would have been $1,250, which is fine. Now, there may be people out there thinking, well, why in the world didn't we go for that $1,250? And the reason is that going for that $1,250 would have required a larger than reasonable amount of risk. That would have required that rather than our stop be $233, that our stop up above this point here on this weekly chart would have been $2,330. That's almost 50% of our initial equity. And here we can see all the things here from our trade, the details. 120, a little bit over 125 pips. So we're happy with that. That's a very, very, very simplified example of a complete Forex trade. Now we're going to have more examples. Do not worry about that. Examples you can follow along with. You can place the same trades in your charts, which I would actually prefer that you do, so that you can see everything that's going on. Now, one additional thing that I'd like for you to do is to, on your chart, I've already done it here, is to create a monthly chart to add to our particular profile here. Okay, now I can close this chart and I'll show you how to create it on your own. Okay, we go up here, new chart. Okay, you see it's our standard chart there. We're going to go to templates, go to candlesticks 1, and there you go. And we go up here, hit the plus sign, make that a little bit bigger for us. You can see that's still hourly, so we go up here to monthly to complete a longer time frame, and there we have a nice beautiful monthly candlestick chart. Okay, so we can easily hide that behind the ones we look at more regularly, or we can go up here and say we're going to tile them horizontally, hourly and 4 hour, and daily, weekly, and monthly, which is fine. We can do it in this way, and each of these, of course, when we want to look at them, we can just go and look at them on a larger scale. No problem at all. So now, this is what we're looking at. I wanted to include the larger time frame of monthly just to give us some additional perspective and really go top down. Monthly, weekly, daily, hourly, 4 hours, hourly. Got ahead of myself there. So does this mean that we're not going to look at shorter time frames? No, doesn't mean that at all. We are going to look at some shorter time frames, and we can set those up. In fact, any of these can be set up to be a shorter time frame. For instance, we could easily do this. Okay, that's saved as that. So let's just say we want to create another profile. Let's see. One moment. I like to keep the profile names consistent. Okay, we want to name that candlesticks, but we want to make it candlesticks and then call it candlesticks intraday. So that's what I want to do. Save EURUSD candlesticks intraday and put it as 1. Okay, intraday 1, because most likely we'll have more than one particular type of candlestick chart. And we save that profile. Go back over here. Okay, I didn't save this particular one from the last time. That was our monthly. That was my fault. So go back to the monthly and expand it. Okay. You can always hide it behind there if you wanted to. Or you can do something standard and then just go through and you're all set there. So we want to save that. And we're overriding the old one, basically. Yeah, we want to override it. So profiles, and let's go down to our candlesticks intraday. There we go. And here, all we have to do is change some time frames. So let's say we wanted to look at a 5-minute chart here, and a 15-minute chart there. Have to have an hourly chart everywhere. 4 hours. And down here, we're going to go with daily. Okay. So there we have that. Okay, so go back over here to profiles. Let's save as Euro dollar US dollar candlesticks intraday 1. And save that. Already exists. Okay, so now let's go back to our standard as we were looking at over here. Euro dollar US dollar candlesticks 1. And make sure it's set up. Yes, it's set up correctly. Okay, so now we've got a couple of different ways that we can work. I hadn't really put the ATR, the average true range, down here on this chart as we had in some of the others, because we weren't necessarily looking for the range of the month in particular, but we can always add that at any time we want. So our next thing that we're going to do is we're actually going to enter an additional trade. We're not going to do that now, so we're not going to make a trade example. What we're going to do is we are going to wait until Monday, and this is Friday, and it is about 4:12 p.m. Eastern Standard Time in the United States, and we're going to let the market do its thing, and we're going to come back on a fresh session and jump right into more trade examples. We're going to run into more indicators. You're going to be introduced into more indicators. We're going to talk more about trading without indicators, so there's tons of possibilities here. And basically, your objective is to learn to control risk, which is what you've seen in this particular example. And there's probably no one that's jumping up and down about making $125 for certain. But that's $125 that was made basically in one day on a $5,000 account while controlling our risk. And our risk was $233 at the time. So we've done a good job of getting into a profitable trade. We've managed that trade by managing our risks, and we've exited that trade. And in this particular case, we've exited the trade at a profit. Not all trades will be profitable. Let's not get disillusioned about that. Losses are a natural part of trading, and learning how to deal with them emotionally, psychologically, is extremely important. Because all through life, we're basically taught to have everything be perfect. In trading, things can be very profitable for you without them being perfect. Sometimes pretty far from perfect, actually. So trying to get 100% winners, I don't want to discourage anyone from that particular goal. Well, yes, I do, because it's a goal that doesn't make any sense. Most of the time when someone's looking for a high percentage of winners, it is because they are nervous about having losses. One reason that new traders are nervous about having losses is because the risk is not being controlled. For instance, in our previous trade, had we been trading a standard lot of $10 per pip, then risking that 233 pips times 10 would have been a big chunk of our initial equity. But by scaling it down and risking a small percentage of our account equity, we placed ourselves in a position to trade in a much more relaxed fashion. $233, if it had turned out to be a loser, it's not the end of the world. $2,330, it turned out to be a loser. Well, how many more times can we have a losing trade of that type? Well, one more time, and then we're no longer trading Forex. I hope that that makes sense. And I know I emphasize risk control, risk control, risk control, discipline, discipline, discipline. And I sound like a broken record, and that's good because everyone else that you come into contact with in the Forex arena should be telling you the same thing. Control your risk. So this is what we've done, and we've ended up with a successful trade at this particular point in time. This one is a profitable trade, and we're going to look, as I said before, at a lot more exciting live examples, so you can see it where the rubber meets the road. I'll be placing the new orders here, and we'll just be chugging along. So I look forward to seeing you in the next module, where we're going to look for an entry point for our very next trade. Thank you very much. Hello and welcome to another live trading module. In our previous module, we traded based upon looking at the weekly chart initially. Let's expand that just one bit. And we sold the breakout of the low of this particular week right here. We sold down here. We came down and we took 125 pips of profit. That's one type of breakout trade. That's simply breakout of the low. Now we're going to go to the next time frame, which is daily. We're going to take a look at some things here. Let's take a pop here, expand that just a taste. There we go. Now here we have two different types of breakouts that we want to look at. Typically there's a breakout of a high or low either on individual bars or on a group of bars. For instance, we could say that we'll take a horizontal line here. I'll just place it right there. We can say that 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We could say that's easily the highest high of the last 10 days. 8, 9, 10. And we could say that that is easily the lowest low of the last 10 days. So this defines what's known as a channel breakout because the boundaries form a channel within which prices trade. Now, as you can see, prices are still inside of this channel for this particular breakout. Okay, so at that particular point, nothing would happen. But how the breakouts work is you basically choose the time period, and this is daily. Then you choose how many days, or if it's weekly, a weekly chart, you choose how many weeks you want to use for a breakout. Now in this case, that was a 10-day. Let's take the objects list real quick. Got to remove both of those. Okay. If you're looking for the last, say the last 3 days, not including the current day, take a look here. That's the highest high. That's the lowest low, basically. So we're looking at, that's the channel right there. So if the price moves up above here, we'd look to get long and buy the euro dollar US dollar going upward. The price breaks down and breaks below this channel that we've defined, then we'd want to sell. In this case, we have more than one type of a breakout trade, right? We have not only the breakout of these last 3 days, we have something special called an inside bar. And an inside bar is basically a bar whose high is lower than the previous high, as I'm showing with the arrow here, and whose low is higher than the previous low. So this bar right here in particular would be an inside bar. And the way it's looking, this bar today on my chart is looking like an inside bar so far, but the day's not over yet, so it can go either way. So what we want to do is we want to sell the breakout on either side of this particular daily bar. So let's take a look and see what the range is and make sure that it's going to fit within our parameters. High minus the low here looks decent. High minus the low here doesn't look too bad either. That would probably be the bar that we'd want to do, is this particular one right here. Even though a lot of people trade the inside bar, they'll trade right here, the extremes of this bar. But we'd like to move to this bar here and use the full 3-day kind of extremes. So that's the 3-day high extreme, that's a 3-day low extreme. Okay? So let's take a look. Okay, that's 176 pips, and that is near our risk parameters. 176 pips, and what we'll do is we'll buy on a breakout of this bar plus 3 pips, and we'll sell on a breakout of that low minus 3 pips. So let's do our calculations here. You can see that our high is 1.48587 and our low is 1.46827. Okay, so we can actually place an order based upon this bar, and it'll be a pending order, of course. So let's pop over. Let's pop to new order, and it's going to be a pending order. Okay, since we look to buy above the market, we're going to place a buy stop up here. And the price we want to place that buy stop at is 1.46827. Okay. What did it tell me? Invalid stop loss or take profit. I'm not trying to stop loss or take profit. Just want to buy stop. Open price you set must differ from market price by at least 40. This is a particular limitation of this platform, is that you have to be so far away in order to do it. But the price is actually 40 pips away, so I don't understand what the problem is. Let's try that again. Make sure I've got my price right. There we go. Always double check your prices, right? Okay. let's start with a whole new order here, since this one seems like it's going to give us challenges. Okay, pending order, buy stop here. Okay, we've got a buy stop in place right up here, right where we want it. Okay, now we're going to place a sell stop. Sell stop at the price 1.46787. Okay. And I think the problem before was perhaps I was putting the sell stop price where the buy stop price should have been. Okay, so here we go. All right, so let's put a comment in here. Let's call it breakout of inside bar and last. How much? I'm not gonna. Let's call it breakout of inside bar low. Okay. I'll say that. Okay. Not sure if they'll let us go through here and because I'd like to label the buy stop. Okay, no, it's fine. Okay, there we are. There we are. We've got both trades in place. You got sell stop here, buy stop there. So this is not one of those trades that's going to be an immediate trade, as you can see. This is what I like to call a set it and forget it trade. I love set it and forget it trading, and let me tell you why. The orders are placed. Your research is done. The parameters are set up. Conditions come around. You see those conditions. You place your pending orders. And then you simply do one of the hardest things for traders to do, and that's wait. And trading is easier once you have patience. Trading is a lot easier once you have patience. So you have to learn to wait, because here's the thing. You want to wait for the right moment. And you want to be as selective as possible in choosing your trading opportunities. Think about all the times in life where you waited for something and you can tell yourself, yes, that was well worth the wait. And I'm not talking about being on hold with a phone company or any of those types of things. I'm talking about things that a great meal or a great relationship or what have you that you waited for. A great trade is the same way. It's worth it. It's absolutely worth it. Otherwise, we're just out there doing things randomly, and we let what we want get, which is to have some trading action, get ahead of what the market wants to give us. And we want to take what the market wants to give us because it's just sitting out there. Just sitting out there waiting. So this trade there's nothing else for us to do here. We are all set, and we'll see how things develop as we see this trade progress. Thanks, and I'll see you in the next module for a continuation of this trade and more live trading. Okay, here we are with more live trading. We've just recently placed this particular trade, an inside bar, a breakout, using daily bars. This is also a breakout of a channel of the last 3 days highs and lows. So it's a channel breakout as well as an inside bar breakout. So this is good. We've got this trade on. What we're going to talk about now is expanding our trading opportunities. So here's what we're going to do. We're going to go over to File, go over to Profiles, and go to Save As. And we're going to go to USD CHF candlesticks 1. Okay, so just name your profile the same way, just like that. There we are. Okay, now here's what we're going to do. What we want to do is we want to use a different currency pair, and we're going to use the US dollar Swiss franc. But we're going to have the same kind of profile setup here. So here we go. Drag, drop, drag, drop, drag, drop, drag, drop, drag, drop. Now here's something that you'll notice is that when we do this, all the trading lines from our orders, showing where our orders would be, are gone. That's because we don't have any orders in this particular currency pair, but we do have orders in the euro dollar US dollar. Just pop back over, go to Profiles. Okay. There we go. Okay, so the whole point of this is that you can create profiles like this for any number of currency pairs. You may have your very own favorites, or you just may want to follow along with what we're showing you here and develop your own favorites. One of the reasons that I like the euro dollar US dollar is because it's traded. It's very liquid, and we want to trade in those currency pairs that are as liquid as possible. That's what we're striving for. The euro dollar US dollar, the US dollar Swiss franc, the pound dollar, and the US dollar Japanese yen, all very liquid, and there are others that are liquid too, but in the majors, which are the ones which contribute the most volume to the Forex market, these are the four that we typically concentrate on. Although you can look into other areas and trade pretty much anything you want, as long as you have your risk control in place, have your parameters all in, have everything all set. So I'm going to pop back over here to US dollar, Swiss franc. Okay, there we go. That's everything we were looking at before, just in the form of the wonderful US dollar Swiss franc. And as you can see, lots of interesting things. You can look around and find patterns and trades that are of interest to you. The nice thing about technical analysis in general and patterns in general is that you can not only apply the same principles to various time frames of charts, such as monthly, weekly, daily, but you can apply them to different currency pairs as well. And things such as our simple principle of the inside bar can work very, very well. In fact, I'm going to pop through here. We could take a look at a couple of these here monthly. You can work our way back and take a look. Where was there an inside bar? Okay, there's an inside bar. There's a breakout. Now, two different ways to trade inside bars, as we stated before. Either the breakout of the high and low of the inside bar, or the high and low of the bar preceding, or as some people say, engulfing the inside bar. So this broke out to the downside. It didn't ever go back up to get stopped out, and it continued down so far. So that's a good trade. This in and of itself is actually an inside bar. It's a big inside bar right here. Here's another inside bar. Break out of that low. That's looking good. Here's another thing to consider as well. Take a look at this monthly inside bar right here. If you're considering trading it, think about the size. Okay, this is this is 1,000 pip bar. So if you're trading on either side of this, then you're talking about 1,000 pip. If you're going short, you're talking about 1,000 pip stop loss on the other side of that. If you're going long, you're talking about 1,000 pip stop loss on the other side of that. So the size of the bars, the magnitude of the move makes a big difference too. Some may have the pattern that you're looking for, but not be of the right type of range of volatility that fit within your risk parameters. See, for instance, this month right here, well, that's almost 2,000 pips. Big move. So you may not want to trade that particular inside bar. So you may look for something, smaller. May look for something along these lines. That's still big. Monthly trading on monthly charts, period, requires either a lot of capital, either that or scaling your trades, your lot size as such that you could take these particular types of trades. And if we're taking trades like this and we're looking at 500, say 500 pips, 800 pips, 400 pips. So if you're looking at 500 pips, we would essentially be looking at a little bit over 3 times what we are currently looking at with 5,000, our $5,000 demo account here, right? So we have to have 15, $16,000 in that area for that to work out. It says 555. So as that goes up, you basically, if you're looking to risk 3%, you look along here and you take, say, this particular bar, the high minus the low of this particular bar, and you see up there that it says, okay, it's 814. Basically multiply that times 33 and you get a rough idea of where you should be with regard to the standard trade. 814 pips with a lot size, not a standard lot size of 1, but a lot size where each pip is $1 rather than each pip being $10 like in standard lot size. So it'd be $25,000, and you multiply that times 10 for doing a standard lot, keeping those risk parameters. Some people choose to risk larger amounts. They choose less conservative ways of trading, I guess is what I'm attempting to say here. In preserving your capital, of course, it just makes good sense. Just stick within 1 to 3%, and because you don't know, no one's right all the time, and you don't know when you're going to be wrong next. And why have one mistake cost you your entire account? Doesn't make sense, does it? No. So okay, and close this out. And here is another profile, another set of opportunities to trade in this market. Could look at the very same thing here, this daily chart, and we don't have a clear-cut inside bar here. This particular day may end up being a clear-cut inside bar with this green bar here engulfing all of it, but we don't have one really clear-cut right there. So we could trade a breakout either side of this. I like to wait for an inside bar before we make a particular move in that direction. We could see if we could do this on a weekly basis. It's already broken out up there. The week's just starting, so we can't really tell very much about that. So we're just kind of, again, just kind of taking a look at some of the different types of markets. Now let's pop down here. Profile, save as. Yes, you already know what I'm going to do next, don't you? We're going to do Great British Pound, US dollar. Candlesticks 1. This doesn't necessarily have to be candlesticks the way we're trading it using inside bars currently, but we'll be looking at some additional things, and candlesticks will be one of those. Using candlesticks will be one of those trading methods that you'll find very handy. Okay, here we go. Okay, so we're going to drag and drop, drag and drop. Again, we're just creating another profile, and creating profiles gives us may give us some additional trading opportunities. That's what we're looking for, rather than simply waiting for one particular currency pair to do all the things we'd like to see it do. We multiply our opportunities by multiplying the number of trades that we get involved in different markets. That's a basic principle of diversification, but we have to be careful because it has to be a truly diversified trade, and I'll talk to you more about that in a bit. But for now, let's take a look. Let's enlarge our charts here and see what the Great British Pound has to offer today. That's interesting on the monthly. Okay, this actually is kind of meandering along there. The weekly is, of course, following suit. Yeah, daily is okay. Nothing. We could look at things. Maybe some bottoming out here due to these particular types of candlesticks. Actually, there we have an inside bar, and we could actually trade the inside bar. Let's take a look. Unfortunately, we can't because 267 pips plus you add 3 on one side for 273 on the other side for 273 outside of our risk parameters. So that's a trade we would pass on. You pass on trades outside of your risk parameters because taking those trades can get you in trouble. Now, when the daily seems like it's too big in a particular currency pair, of course, you can always look for those same patterns in smaller time frames, like the 4-hour here. 4-hour is this is a very popular time frame to trade, and it's short term enough for those who enjoy the action itself of Forex trading, because it can provide a lot of trading opportunities, while long-term enough to produce some nice, meaningful moves, as we can see here. Actually, you see right here, breakout of that inside bar. Actually, it's to both sides. That's another technique called fading the breakout. So you wait for it to break out one side, and you then place your pending order on the other side of that bar prior to the inside bar. And in this case, if you're going, would have first gone long, perhaps, and then down here, short to stop yourself out. But you want to stay short. Another inside bar here. And this inside bar, as you can see, spinning top. We'll talk about candlesticks, but spinning top, inside bar, and you can see here the slowing down of that particular downside momentum. Going back up. That's actually called an outside bar when the high is higher than the previous high and the low is lower than the previous low. That's kind of the opposite of an inside bar. Another inside bar, no breakout to the downside. There is a breakout here to the upside. Let's see, yeah, we would have still stayed long based upon the breakout to the upside. And once you're in an inside bar trade that's going in your direction, let it continue in your direction. Right? So we'd still be long, still be long, still be long. Then you could either trade, again, the breakout of the inside bar itself or the bar prior to the inside bar. We'd be doing that to the short side. You can see all these things here, which mean that upside momentum is slowing down. You can see that in these candlesticks, that doji and the spinning tops here. But nothing I would trade in particular right here, looking at the 4 hour or even the 1 hour. But again, it's here in case you want to come back and take a look at the pound dollar, or we both want to do that later. So okay, we're going to pop over here, and basically this is our exercise in profiles. It's another very popular currency pair to trade. I'll pop in here and let's just set our profile up. Sorry, wrong one. No problem. If you put the wrong thing in there, just put it in here. Whatever you pop over the top of it, it replaces the previous currency pair anyway. It's pretty neat, huh? Yeah, I love the way this works too. So, okay. So there we have it. Let's see what the US dollar Japanese yen looks like. Monthly, could be some bottoming out there. Let's see weekly, what the weekly looks like. Okay, just approaching some previous lows back here from December 08. That's interesting. Daily, let's see what things look like. Okay. Japanese yen can really get moving. I don't see any particular pattern that we may be interested in here, so okay, let's see, 4 hour. Again, just shows you have to be selective, and mm, 1 hour. The 1 hour still in a breakout of this particular inside bar, the low of that inside bar. This one doesn't look too, it's not down there, so I'm not necessarily thrilled about what I'm seeing in these particular trades right here. So we'll probably just get back and take another look at those at another time. Here we are back at our euro dollar US dollar trade. Nothing's happening, so there's nothing else to do here. But we've got some additional profiles set up, and the takeaway, as they say, the things to be learned in this particular continuation of trading real time is that when you do find good patterns and good trades like inside bar breakouts, then you can do those on a number of different time frames as well as a number of different currency pairs. So this, it always gives us something, some potential that's somewhere and something that we can do. All right. Until the next module, well, we'll be looking at live trading once again. Thank you. Okay, here we are back again today, and we're in our trade. We are officially short the euro dollar US dollar. And let's take a look here. Let's go down here to, okay, so we are 38 pips to the negative currently. And judging from the looks of this, we've been about 53 pips to the positive. So we've had an opportunity here to take profits if that is what we wanted to do. We wanted to stay in this trade longer for the purposes of demonstration and not set any trailing stops. We'll pop in here to the hourly and take a look real quick. We broke through here and sold off. Went down nicely. Now actually when we were 53 pips to the good, we could have actually placed a break-even stop right back here where we were in the market before. If, again, our trading methodology was calling for that particular type of stop. Okay. Now I'm going to start on the larger time frame. We're going to work our way back and look at a few things, and we'll also talk more about stops and stop placement as well. The monthly chart right here, we're taking a look at the monthly. I just wanted to make that a little larger. You can make your adjustments here by zooming out or zooming in. Zoomed in for a taste here. On the monthly chart, again, it's been a strong upward move, strong downward move, strong upward move. And we haven't broken out of the previous month's high or low. So there's nothing really significant happening. We're really in the middle of the range here, okay? All right. Pop over to weekly. Here we go. All right, into weekly. Now we were previously short based on a weekly chart because we found a weekly chart pattern, and we found a weekly bar that was small enough to fit into our risk parameters at the time. So we sold at the break of that weekly low. Now here, as it happens, we're selling the break of this weekly low, and it has broken down. We have some negativity there, as evidenced by the red candle, but it's early in the week. Now here's what we really based our trade upon, was the daily chart, placing our stop up here and our entry point right down here. So again, we came out a little bit to the good, then the market moved back up against us, and this is where the market is now. It's about 1/4 of the way back up to where our stop is. And we're going to leave our stop in place currently because it's based upon what we've got drawn up here where the market had a little problem getting through that as our resistance line. It did break through support, and we sold based upon that. Take a look at the 4-hour here. Top down trading again. Had a nice size bar down, and then a turnaround bar. And this is the reversal bar here, actually. It's the bar up. Then we move up. And here's where we are right here so far today. Okay, we can expand that if we want. Since we've been expanding them, we'll take another look at it this way. Now here we are. We've come down here. We started to move up. And we really are kind of meandering. But then we do have a push back into the territory here inside of our trade. In fact, we take a look at that on the 4-hour. We're inside of that, of our, back inside of our channel. We make profits when we get outside of our channel. We make losses if the price goes up to this point. And it's important for you to see these numbers. Again, that sometimes the market will immediately go with you and you're in a profit, and there are times when it simply will not look back and it'll continue in that particular direction. In this case, it went nicely with us, and then it reversed and went back and moved in the opposite direction. So that again is, a natural part of trading. One tendency that many traders tend to have is to want to move the stops. And it's, believe me, it's quite natural. No one enters into a trade and go, hey, I immediately want to lose. That's not how any trader's mind works, even the most successful traders. So the tendency is, wow, you get a little bit to the good. I'm going to, protect my profit here. And you keep hearing sayings such as, you can never go broke taking, a profit. Well, that's not exactly true. The account equity, which is the sum total of the amount inside of your accounts, and follow the arrow here, we'll go down to the bottom here. We're about 85 pips to the good in our account. That's thus far. Okay? And that's the equity. Your account equity grows when the sum total of your winners is greater than the sum total of your losers. So, for instance, if you have a series of winning trades and they all add up to $15,000, and all your losing trades all added up to $10,000, then you've made a $5,000 profit on top of your initial equity, whatever that might have happened to be, what that might have been at the time. So the tendency, again, as we stated, is to want to do something all the time. And you can do that, again, dependent upon your trading methodology. You can set your stop to break even. You could set your stop back here, and you could trail it along these highs here. I'll give you an example of what that looks like by putting some horizontal lines down. And you won't be able to put very many down because it didn't go very far in our direction. But once it got down here, you could actually do that, and you'd be able to pull a profit out, which at this particular time, that doesn't look like such a bad idea, does it? Wow, we could have grabbed a profit instead of being currently in a loss. Well, a lot of things happen in the middle of a race that don't really have anything to do with the outcome of the race. And the market's moving to and fro, fluctuating as we call it, is completely natural. Giving the market enough room to move, that can be the challenge. That could be the challenge, especially for individuals with smaller account sizes, but it could be the same challenge for, let me erase that line, for people with large account sizes if they are risking too large a percentage of their equity per trade. Okay, that was a long-winded way of saying we don't have to do anything with our stop. We're going to leave this trade as is. We're going to leave our stop up here. And yeah, we could actually trail it down to any number of these points in an effort to reduce our exposure. And some people will actually go through and move not only a stop to a break-even point, but a stop to points such as these, that high, then down to that high, then down to that high. Of course, someone would have been stopped out at that particular point. And that's called a trailing stop because it trails or follows the price action. So a trailing stop on a sell gets lower and lower and lower and lower as the price moves down. Going upward, a trailing stop gets higher and higher and higher and higher. And a trailing stop is designed to help the trader preserve the profit or capital in general. And it's a very useful tool when we give the market enough room. Now you can imagine having a trailing stop that's 1 pip. Quite obviously, it would have to be a very slow moving market for a 1 pip trailing stop to be effective. I would venture to say you get stopped out a lot trying that. So with all that in mind, and again, the long-winded way of saying we're going to have to be patient and we're going to see where this trade goes. Now, the possibility that the market can move all the way up here and stop us out is there, as well as move down from here and get us into a better get us into profit and a better position. So what we're going to do is we're going to leave this trade and we'll come back to it and we'll take a look at it and we'll see where we are from there. Thank you very much, and I'll see you in the next module. Hello and welcome back. We are still short the euro dollar US dollar, and as you can see here, the market has moved against us, and we are down 164 pips currently, and we're watching the market move up towards, right here, towards our stop. Now, what most likely will happen in this case is that we'll see some continued activity to the upside, and then we'll see the stop get hit. Okay, so when we see the stop get hit, that's important information to know because every trade's not a winner. We stated that before. The key, of course, is to have the sum total of your winners be greater than the sum total of your losses. So we look back down here. This is where we are equity-wise. And this is important, too, because you have to evaluate how you feel about actually being in negative equity. So at 49.61, we're actually below the $5,000 mark that we started off with as far as profits is concerned. So that in and of itself is something that we need to digest, and it's important. Now, it may not sound that important right now as we're working on a demo account, but believe me, when it is real money, it will be important. So treat it as if it is, Now, the $163, $165 down that we are currently out of a $5,000 account is not cause for panic because we are properly trading using risk control. We have the right lot size right here in order to take a number of losses and still have enough in our account to continue to trade. That buffer is very, very important because no matter how many good opportunities come along, if you don't have the money in your account due to poor risk control or whatever, then you won't be able to take advantage of those opportunities. So we'll leave this, close that down. And what I'd like for you to do is go over to your profiles. And remember we had a euro dollar US dollar candlesticks intraday 1. So click on that and open that up. Okay, there we are. Now, what I'd like for you to do here is go to profiles again and save profile as. You can pop this up here, but we don't want that name. We actually want USD CHF. So we're interested in the dollar Swiss franc. And we'll save that profile, and then what we do is we go over here and we drag and drop. There we go. Drag and drop in this manner so that we have this one intraday as well, because what we want to do is look at a shorter term trade. So what we'll do is we'll take a look here and let's enlarge our charts. Daily. We're just kind of meandering back and forth there. So there's a breakout right here to the downside of that daily bar. So that would be an interesting trade. It'd be interesting to see what would happen down here to a breakout of that, but we're looking for something shorter term. The trend here is clearly down. Now we may bounce back up at this particular stage because of these prices here, which may form some level of support. And again, support being a place where prices do not seem to be able to penetrate on the downside, and resistance is a place where prices do not seem to be able to penetrate on the upside. Okay, that's 4 hour. Let's take a look. Top down trading. The 1 hour chart. Again, getting ready to bounce back down into this particular area. In 15-minute. Five-minute. I don't see any necessarily intriguing types of trades here. But we could always, again, take a simple trade that's some people will take a breakout of a 5-minute bar as well and trade that particular breakout, which is interesting. So there's an inside bar right there too. We could also trade that on either side of this particular bar and sort of bracket on both sides. But in this case, we're talking about intraday, so we again have to look at risk reward. So we can take a look at, if we were interested in this trade, I'm going to take the ATR, or average true range, move this down here to 1, because I'm keenly interested in where we stand here. And you can see this very small number of pips we're dealing with as far as that the ATR. Basically, when I set the ATR to 1, it's an average. It's just the one bar that we're looking at. Okay, so having that's kind of small. I'd rather move up actually to a 15 minute, and let's see what that looks like. I just want to see the range of the bars, especially if we're looking to uh, buy the breakout of the high, sell the breakout of the low. And it's interesting here because it has broken through this particular price to the downside. That's interesting, isn't it? Has broken through. So let's see what we look like here. Not very many, 10, 11 pips here and there. Now we could always take this short side trade right here. We actually take that trade at the market and place a buy stop right above this level here. That could prove to be relatively interesting. Let's go to an hourly. Okay, I'm going to reduce this again. Okay, here we go. Okay, Okay, so 37. You can see the various sizes of the pips there. 37. Okay, all of trading on this in this range is all within our risk parameters for certain. We can trade that with no problem. Let's see the 4-hour. Okay. And in reality, the 4 hours are fine too. Again, the larger the time frame, the bigger the range is going to be. And you have to adjust your risk parameters accordingly, and also your reward parameters. If we're looking at 5 minutes, then we're seeing 10 pips here, 10 pips there. But as we're looking at larger time frames, we're looking at 20, 30, 50 pips, etc. Let's take a look at the daily. And I'm going to have to pop in here. Where are we? There we go. And grab an ATR. I want it to be a 1 period. Just want to see the range. This is a handy little way for us to gauge risk and reward. Okay, so we're seeing things back here in the range of 100, 150 pips. But this is a sideways daily. It's sideways. It's, of course, the main trend has been down, but it's not doing very much in here. Really, I'd like to see a breakout of one side or the other of this in order for it to show us that it wants to go in one direction or the other, so that we can have some real momentum. 4 hours. Let's see, 1701. Okay. No, not really. Not seeing anything particularly interesting in. We could trade this, the hour here, and we could trade a breakout, and we could trade a breakout again based upon some support down here, and have our either breakout on the upside or on the downside. That's one thing about the market, as you'll notice. It's going to go one direction or the other, or meander back and forth. You see every bar, some are definitive. Some bars are breaking out. You see that bar's testing that high. As we said before, testing that high. Things get tested. Now, here in this case, this is a kind of middle of the night inside bar trade. You see these all come down this way. That's the end of yesterday, actually, looking real good. So I think in essence what we're going to do is we're going to leave this alone until we see something a little bit more definitive, and then come back and find something that makes more sense to us as far as the trade's concerned. So we'll reduce that. Okay. And that's that. Okay, so let's pop back to our other. We've got this profile there, so we're all set there. I'll go back to our trade that we're in, and it's up here dancing around at these levels, looking like it's going to go up a little further and perhaps stop us out. So we'll have to see what's going to happen a little bit later. So for now, we're going to leave this alone. We'll come back and we'll seek out an additional opportunity in perhaps that US dollar Swiss franc a little bit later. Sometimes there's just nothing that seems clear cut, so you want to leave those things alone. So we're going to do just that. We're going to leave those things alone, and we'll come back later and trade some more. Thanks. Okay, what we want to quickly cover today is adding additional expert advisors and indicators to MetaTrader. Okay, so down here you'll see in the navigator window a list of indicators. You also see a list of expert advisors right here. Okay, we have one down here, and I'll show you where you'll need to add those in order for them to show up down here in the navigator. So what we're going to do, the first thing we're going to do is we're going to close down MetaTrader. Okay, go up to File and Exit. Okay, now this is where you place the expert advisors and indicators that you get that are commercially available. If you buy a Forex robot that is an expert advisor, then you download it. Probably it's in a zip file. You would unzip it, and what you want to do is to go inside of your MetaTrader installation in your Program Files MetaTrader directory. Then you want to go to Experts. Double click on Experts to open. As you can see here, we have the moving average experts. Okay, and what I've done is I've just stored a couple of expert advisors here. This is just for the purposes of illustration. They don't go here. These are some I just stored here just so we could copy them to the correct directory. So I hit Control C, go back over to Experts, hit Control V to paste, and the MACD sample and the other MACD samples show up. Now there are two different types of files here. You'll see an EX4, which is the executable file, as well as the MQ4. The MQ4 is an editable file that you can open up your editor, MetaTrader editor, and make changes to it. The reason you're seeing these in this case is that these are demonstration files that come standard with MetaTrader. If you're buying a commercially available expert advisor, you will get the .exe file, which is not one that you can edit. Now also notice that this is in the experts directory, straight in the experts directory. Now in a subdirectory of that called indicators is where you would place any indicators you would have. You download an indicator, you buy a new indicator and download the EX4, and it is going to show up. You want it to be in here, so it'll show up in the navigator window. So let's start MetaTrader and see where the new expert advisor is. Okay, here we are. So let's go down and click on expert advisors, and there we have it. MACD sample shown up. Usually when you're installing an expert advisor, it will be smart to shut down MetaTrader prior to the installation of the expert advisor, and then place the expert advisor in the correct directory, in the experts directory inside of your MetaTrader directory in the program files. Well, that almost sounded a little confusing, isn't it? Your installation directory contains an experts directory, and that's where you place the expert advisors. And that experts directory, there is a subdirectory called indicators, and that's where you place all of these, is in the indicators section. Since we're here, let's pop in and take a moving average expert advisor, and to get an expert advisor activated, you simply left click, drag it, place it on the chart. You'll notice immediately that there are inputs that you can change. If you want that to be 1 lot, you could do that rather than 0.1. You could change these things too, provided you understand what things are to be changed. If you're using a commercially available expert advisor, then it's advised to use the standards as dictated by the vendor. Okay, wildlife trading. Okay, click up here on expert advisors to activate, and when you see the smiley face, you'll know that everything is just fine and that it's all set to automatically place trades. Now what I'll do now is I will remove the expert advisor, and that's that. Okay, the same holds true for indicators. You grab an indicator you like. Let's see, moving average. We drag it, go on a different chart here. And this is a 10 period moving average. Simple moving average, okay. You can do that there. MACD, you do the same here. And you can change things around here, again, dependent upon what your particular methodology dictates you should be using. Okay, indicator list, MACD, I'm just removing it. Right click or Control I. Just cleaning up the charts here, so the charts are all nice and clean. So you see where that is on the navigator menu for all of your indicators, expert advisors, custom indicators as well. And that's basically it. You see how simple it is to install an expert advisor and get it up and running. And basically all of these that are commercially available will have a set of instructions with them that make it very straightforward for you. So next, we're going to continue to explore more of MetaTrader. Hello and welcome back. As we wrap things up in our final module, I'd like to cover something very important to all Forex traders that you don't see mentioned very often. Now, what we want to do first of all is we want to have a look at our typical screen here that we've got set up in our profile. And we're looking around here at the euro dollar, US dollar. And it takes time to kind of line things up and let the market travel into the areas where the trading opportunities are the best. This is why you won't see and haven't seen examples every day. Being patient that's part of it. It's a very important part of trading. So keep that in mind. We've covered setting everything up, getting you ready to trade, and then this important final component, I'm going to cover something known as correlation trading or Forex correlation. Now let's take a quick look here at monthly. See, we're down on the month here. Now this is a fresh month, so not too much is going on so far. Down in the weekly, down in the daily, obviously. We've got a little bounce there. 4 hour, not too much going on. And up here, sideways actually. So what I want you to do is let's stretch this out this way. Okay, and also go down here and grab this one, and let's grab that chart and stretch it out this way. Now, the next thing I want you to do is to take this chart here and transform it into a 1 hour. And the very next thing that I want you to do is to take the bottom chart and transform it into a US dollar Swiss franc chart. Now you'll notice something very interesting. Do you see it? I know you can tell me exactly what it is. And what it is that we are looking at basically a mirror image. This bottom chart appears to be a reflection of the top chart. What does that mean? Well, that means that the euro dollar, US dollar, and the US dollar Swiss franc have a very high level of correlation. When the euro dollar goes up, the Swiss franc goes down. And that happens in varying degrees, and the amount of correlation, quite naturally, does vary over time based upon volatility and a number of other factors. But as you can see here, if we took this and let's go up to daily on that one, let's go to daily on this one, go to weekly on this one, go to weekly on that one. You see that? In every time frame, basically, it is a mirror reflection. So why is this important, you're asking? Why are you showing this? Okay, we're showing you this because what many people mistake for the safety and risk control of diversification is actually absolutely nothing of the sort. What do I mean by that? Okay, let's say, for instance, we were at this particular point on the weekly, and we thought, wow, this is really good. What I want to do is I want to use a system that says, hey, I'm going long. And this is, of course, hindsight, so this is just a hypothetical example. Please understand that. So I'm going long. I'm going to go long here. And you have another system which you use that says, hey, listen, I should be going short the US dollar Swiss franc. Okay, so you've got two positions on. You're feeling excited because you're like, well, I've got two trades on. I'm diversified. I've got money in the euro dollar, US dollar, and I've got money in the US dollar, Swiss franc. So the trades are on. The fact of the matter is you're not really diversified, because going long the euro dollar, US dollar is the same as going short. So effectively, you have basically put on two of the same position. Now, don't let that confuse you, because as you can see, going up here, going down here. Now, in this particular case, you would have been in really dandy shape, because quite obviously the market went up. Of course, you didn't know that down here. And quite obviously the market down here went down, right? So you would have done just fine if you had taken the other type of trade, where say you were going short here and you decided to go long here, thinking that you were diversified. And to some people, diversification means I have on more than one trade using more than one system. But the truth is, what effects is it going to have on your equity? This is basically it. What's going to happen to your equity? This is the core of all of it. And what happens in this case is it is not true mathematical diversification. Now, I'm not going to continue to rave on and on about this. I just want you to understand it's important. And you can do experiments with the different currency pairs here using this same kind of method that we have shown you here, in order to gain some perspective on what's happening. So let's go here to hourly. Let's go here to hourly. Okay. So here's something interesting. We're actually going to place a trade, and we're going to use correlation to help us out. And I'll show you how you can do that. There are ways that you can offset your risk by using correlation that are very, very handy. So here, let's take a look here. Now let's see. Let's say we wanted to go short here. Okay. Now if we go short in the euro dollar, US dollar, for whatever reason we choose to go short, we can offset some of that movement by also going short in the US dollar, Swiss franc. And let me show you what I mean by that, so you can actually see it as far as changing equity is concerned. So I'm going to look here, look at the trade possibilities, and really, rather than necessarily waiting for a setup, I'm going to get us in a position to dive in so that we can see this in real time. Okay, so the first order is I'm going to sell, and I'm going to sell this particular thing at 1/10 of an entire lot. I'm going to sell the euro dollar, US dollar. Okay, and I'll just give you an example of how this can work. So there we go. I've sold that. Now what I'm going to do is I'm going to immediately go down here and I'm going to sell the US dollar, Swiss franc. Okay, so I've sold that. All right, now you can see right here what kinds of things are happening, and you can see things change. Now watch this number here, which is the profit, and watch it very closely how it bounces around. Okay, very interesting stuff. Okay, it's starting to move. Now you see that. Now the combination of these two things um, can be called what's known as a synthetic security. Okay, and synthetic security is it's like a made up security composed of several discrete individual components. Now we know that there is no currency pair known as the euro dollar, US dollar, US dollar, Swiss franc. It wouldn't be a pair, it'd be a quad. So, but that what we actually have trading here. Okay, we actually have basically this price movement here is the price movement of our synthetic security. And excuse me if that seems a little strange to you, but many people will trade, naturally those who are knowledgeable, based upon the movement of this particular synthetic security. And you can see it moving along here, and the whole objective would be either to offset some loss in one direction and sometimes to just basically have this trade until it moves into a positive area and close out that trade for what's known as a scalp, in fact. So that makes that very interesting. Now you see how that's moving along. See the changes here right down there? And keep in mind that there are a number of different ways to do this. And you say your trading system has dictated that you're going to go short this particular currency pair, euro dollar, US dollar. Another way to do it, rather than looking for the combination of the two to move in the positive territory, is you can simply leave your short trade on, and when your short trade down here moves into positive territory, you could have you could have a simple profit target, and say you wanted to get 20 pips. When it moves into 20 pips positive territory, you could then be in a position to simply grab that 20 pips and use that 20 pips to offset any movement against your original trade. So I hope that makes sense. I know it may be a little bit confusing because this is a concept that not many people, if any, are talking about. Correlation trading is something that you need to know about, and you need to know about the relationships between currency pairs as you're doing your trading, because otherwise what you'll be doing is you'll be doubling up your position when you didn't really care to. Now say again in our example that you're going long in the euro dollar, US dollar, and short in the Swiss franc. Then if you're risking, say, your 3% per trade, then you end up effectively risking 6% because you're effectively using two trades which are the same. So as the market moves, as the euro dollar, US dollar goes in one direction, the US dollar, Swiss franc goes in the other direction. I know that's okay. I may be confusing. I don't want to lose anyone here, but let's go back down, and you can see where we're moving here, and we're letting things move along as we want to, and the market hasn't really gone anywhere, has it? You know, it's been relatively quiet. It's been relatively quiet. So when we look for some sizable movement in one direction or the other, and we would have an opportunity to come down and close out our entire position as a profit for a profit here. And as you can see, we're still in negative territory here, so there's nothing that's really going on. Now here's another technique that you can use. You can actually leg into these. You could actually sell at the same point we sold before, the euro dollar US dollar, and then you could allow it to move into a profit. Okay, and when it moves into a profit, then you might want to sell the US dollar Swiss franc, and that will actually help to protect some profit, because if you sold it and this is moving down, then if it goes back up, the euro dollar US dollar is moving against you. So it starts to go up, the US dollar Swiss franc starts to go down, then you have an opportunity to grab some profit. And even though it's moving against you here, you're still making some money down here, where you can lock in 5, 10, 20, 30, 40, 50 pips or so as things move along. Okay, let's see how this trade develops. I'm going to place this on pause for a moment, and we'll be right back. Okay, we're back, and what can you see that's different? Okay, let's take a look down here at the changes. You see where the pips have moved up here, and the euro dollar US dollar moved down here, and you can see that our overall equity has gone up rather than down. It's pretty good stuff. So you can adjust things depending upon the direction you feel the trade's going to go. Or if you're in a scalping mood, like we're going to be right now, we're going to jump in with just a little bit of profit, and we're going to close that order. Now we're going to jump in and we're going to close that order. Done. Okay. Let's see, account history shows last two trades. Okay, and you can see here 24.30 plus and 20.41 minus, for a total of 3.89 to the positive. Now, in using a standard contract, we would see movements that would be greater. In fact, they'd be 10 times as much. So that would be basically a $38, $39 profit quickly taken. That's, again, you take profits that quickly, that's simply a scalp. So just a quick scalping trade, and that's an example of one way to trade using Forex correlations. I hope that you can see how important correlation and understanding correlation between various currency pairs can be to your trading. These correlations can also be used when looking at levels of support and resistance. So for example, we'll pop here to a daily chart, and we'll just run into this as a sort of an added little level of bonus coverage. Okay, let's draw this. Okay, horizontal line here. Also, I'd like a corresponding horizontal line there. Okay, so these areas where the price can't get through or doesn't go through, don't say can't, never say can't when it comes to the market. The price seems to be tough. It's resist going through the top of that. That's a level of resistance there. Now, the opposite is true when the prices seem to not be able to penetrate a bottom. That's an area of support. When you're using correlation, you can see how these line up down here in that same time frame. Right around here, as you can see on both those charts, it's resistance up here at the top, at the same time support, and that becomes a turning point in which the market begins to travel in the opposite direction. And levels of support and resistance, some people believe they are sort of self-fulfilling prophecies that folks who use technical analysis swear by. But the reality is, you can see there are certain levels where, self-fulfilling prophecy or not, where the price seems to bounce off this invisible ceiling, if you will, and it seems to bounce off this invisible floor. And looking at these types of prices and levels gives you a lot of insight into things which may happen at some point in time in the future. So moving even aside from correlation trading into just straight levels of support and resistance, I'm going to increase the size of this chart so we just see the euro dollar US dollar here. Okay, you can see we bounced off this level. This is a daily chart. Okay, now give me another level here. We bounced off here, went back across, all the way back up to the top. We actually penetrated, but you can see this here, this candlestick pattern. We moved back down. Then we tried to penetrate again, and we came all the way back down to this level. Now, everyone who follows support and resistance will be looking for things to stall out at this particular level. And as you can see, they did, because we had a big bounce up, almost, well, it was past the halfway point of the previous day. We had a big bounce up, and then we started back down again. So we may see that prices may attempt to penetrate this level and go further down. Then the next point to look for would be down here. So support and resistance gives us a number of things to look at. And one of the important things is a level of risk and reward. So say, for example, we're up here and we travel down, we come down here, and we're moving back up. So we've identified this as a level of resistance, and we're wondering, okay, how much can we risk if we wanted to go short? I mean, you start to see the spinning tops, the candlestick patterns here, which are indicating that this upward trend is exhausting. That's basically a doji right there for all practical purposes. And we're expecting price to come up near here and bounce down. So if you were looking to get long in this area, for instance, you already see that there's resistance up here. So if you're already looking to get long and there's a possibility there may be a bounce off resistance, then your reward is not that great. Whereas the risk on the short side from here down to this level of support is pretty huge. It's pretty huge. Okay, so that makes perfect sense. You can see this for yourself, and these levels are true really regardless of the market. I'll pull another market over here, and we can draw some levels so you can get a quick look at what's going on. Let me turn off auto return there. So we'll just go back a ways. Okay. And let's look at our resistance being up there, our support being down here. And let's go by here one at a time again. We bounce off. We're moving up nicely. Now, you'll notice this may be a more major level here. And as we come down further, other levels come into play. Okay? You can see this level here. Moves up, bounces off that level, comes back, bounces off that same level that we previously identified. Let's see what happens as we move on. Okay. Bounces off the level, goes up, doesn't quite make it, comes back down. It's pretty even along here. This period in which the price moves back and forth is known as congestion and consolidation as well. Those are two names used for it. This entire corridor can actually be considered a huge channel of congestion. Now, as you can see, stalled around here long enough without going up. Sometimes that's an interesting sign too. Okay, and move down nicely. Okay. So we're going through and we're drawing levels of support and resistance as prices change. Okay, here we go. We have new support there. New resistance there. Falls down through. New support right here. And it narrows along and we just kind of meander around. Okay, so if you're looking here to get short, then the possibility that you get short and it run all the way back up here is strong. And so you have to look at the chart and determine if that level of move from here to back here, if your stop's back at this point, if it's worth it for you, if that works out for you. In this case, that's about 170 pips. So that's within acceptable using the 1/10 of a standard contract size, as we had discussed before, for the amount of our demo account. Okay, I'm going to pop this back up here. And we're going to go back to our original chart here. And again, these principles are applicable using any time frame and any currency pair. That makes them extremely useful and universal. Go back to our standard chart. Okay, daily, that's going to be 4 hour down there. So what we've covered is setting up our MetaTrader software, first downloading and installing. We've covered the file menu, the insert menu, installing and activating indicators. We've also covered basics of MetaTrader charts, as well as an introduction to the all-important risk control. We've had quick start tutorials as well as some sample trades with inside bar breakouts. We've looked at channel breakouts. We've looked at support and resistance. We've looked at a number of different things here. We've looked at how to actually place orders. We've looked at controlling our risk, which is quite naturally of paramount importance. We've looked at lots of things here. So we've covered the basics of what you need to trade successfully. And in reality, you could use something as simple as the inside bar breakout and be wildly, wildly profitable. So you have the basis right here and right now to experiment. And with a demo account, you can experiment with no financial risk to you. One word of caution with regard to a demo account is that don't get wild in the demo account. Okay, what I mean by that is that you should keep your risk at the same levels that you will have them when you trade your actual account, when you open up your real money account. So if that happens to be 3%, don't risk 30% in your demo account. Practice makes perfect. And if you practice the right things, you get better at doing the right things. And there is nothing that's going to be more important than controlling your risk. That will keep you in the game. It will definitely keep you in the game. Keep in mind also that sometimes being diversified is more, let's just say there's more to it than meets the eye. It's more important to realize whether you're diversified, even though you're trading two different currency pairs, as we had our example with using the Euro dollar, US dollar, and the US dollar Swiss franc, which, as you can see, they have a very strong correlation to one another in the opposite direction. As one goes up, the other goes down, and vice versa. Keep that in mind. That will also, correlation also allows you to control your risk. So we've covered this. You have all the tools right here at your disposal to start performing your own tests, giving your ideas a workout, and make sure you keep meticulous records when you do this. That's very important. This way, you won't be fooling yourself, because when you try something, you want it to work. This is typically how it works. Keep this in mind, okay? Keep this in mind from this training, and take this away. When you're going through an idea and you're seeing something, it can be on any particular chart, could be Euro dollar, US dollar, 1 hour, and you have certain ideas about where to get in and out with support and resistance. Write down what your idea is, and write down what you want to test and why, and also write down your results. Don't skip any bad results. In fact, take this bit of advice. When you have an idea or a method or trading system, your objective really is, in testing, is to break it. You start off and you trade with it, and you look for its vulnerabilities, and if you find a system that you cannot break, that sounds like that's a very good system to trade. Listen, it's been inspiring to be able to share our Forex experience and trading expertise with you. We thank you very much for your participation in this Forex course. Good trading and best wishes to you. Thank you.